panel discussion where we're going to be talking about secrets behind a chart-topping returns time. So for this, we're going to be joined first by our moderator, Mr. Deviprasad Nair, who is the head of business development of ICICI Prudential PMS. He's also responsible for sales and business development of ICICI Prudential Portfolio Management Services. He is a seasoned financial services industry professional with over a decade of experience in institutional and retail sales and in setting up strategic business units within the asset management industry in India. Mr. Devi Prasad joining us today. Thank you so much for agreeing and being a moderator for today's session, sir. And on that note, I'm also going to be introducing quickly our panelists for the day. Our first panelist, Mr. Deepak Shenoy, the founder and CEO of a Capitalmind. Capitalmind is a Bangalore-based firm, wealth advisory and portfolio management service with about 20 years of experience behind him in the financial markets. Joining us today is Mr. Deepak Shenoy. Prior to this, he had co-founded two startups, Agni Software and Money Yoga. He was one of the earliest in India to start an algorithmic trading firm back in 2009. He has a BE in computer science from NITK Suratkal. Thank you so much, Mr. Deepak, for joining us today.
Thank you so much, Shruti. Thanks for having me.
Thank you. And our next panelist who's going to be joining us, Mr. Amit Jeswani, is the founder of Stallion Asset. He is a double charter, has successfully completed his chartered financial analyst from Virginia, USA, and chartered market technician from New York, USA. He graduated in the business with finance from Kingston University, London. He has been investing in capital markets for the past 14 years. He started at a tender age of 16 as his father was a stockbroker and has worked with various financial giants. Thank you so much, Mr. Amit, for joining us today.
Thank you, Shruti. Thank you so much.
Right. And on that note, we have two more eminent panelists that, who are going to be joining us. And with no further ado, I'd like to introduce and welcome on board Mr. Rakshit Ranjan, the founder and portfolio manager of Marcellus Investment Managers. He is a BTech from IIT Delhi and a CFA charter holder with over 14 plus years of experience in financial markets. Since 2011, Rakshit has led Ambit Capital's consumer research franchisee, which got voted as the #1 for discretionary consumer and within the top 3 for consumer staples in 2015 and 2016. Thank you so much, Mr. Rakshit, for joining us today.
Thank you, Shruti. Thank you. Good evening, everyone.
All right. And last but not the least, our last panelist joining us for this very interesting discussion, Mr. V. Jayaram, the CIO and a fund manager of Joindre Capital. Mr. Jayaram is a chartered accountant with more than 25 years of experience in equity research and funds management. He is an ardent believer and a follower of value investing philosophy. His experience and in-depth understanding of the markets and financials ensure that each investment decision will be in the utmost interest of the client's portfolio. Thank you once again, Mr. Jayaram, for joining us today.
Thank you and good evening, everyone.
A very warm good evening to everybody who's joined us here for this panel discussion. Over to our moderator for the session, Mr. Devi Prasad.
Thank you. Thank you very much, Shruti, for that wonderful introduction, and very good evening to you, all the panelists and the viewers. It's really good to be part of PMS, AIF, and ET Now event. As you know, as it's been happening for this is the third time this event has been hosted, and it's been hosted on a virtual platform, which is fantastic. If you consider last 12 months, except of December of 2019, past 12 months has been pretty choppy, and the steep movements in the India VIX index itself go into the history. It by itself will go into the history of Indian equities. That that said, amidst all these, we had few portfolio managers who've been able to register chart topping return, and that's why we are here to get the secrets out of them behind the chart topping returns. One more thing which is very, very particular to this panel, and which is very interesting, which I must tell, is that I found all the eminent panelists with different style of investing, and they have style. The different styles are about momentum investing, and value and growth, or growth or quality, right? So all the styles are there, which actually puts, a lot of criticism or the discussion around which style works, or which style is superior to rest, because that's why they all are here, because they have delivered such kind of performance in the past year, and all the strategies have worked very well. So to begin with, let me begin with you, Deepak. Can you tell us something about the momentum strategy which you run at Capitalmind PMS? Also, that how easy or how difficult it was for you to sail through the turmoil during the Feb and March, and still deliver about 20% alpha over the reference index Nifty.
Good evening, Devi Prasad. And I think from a point of view of this particular strategy, we're talking about momentum. If you think about it, it's so I'll explain a little bit about the strategy and talk about how it
Yes.
went through the turmoil. So the idea of momentum is that stocks that seem to have momentum, that means they're going up and they're going up with strong volumes and strong price increases, they tend to retain that movement over some period of time. Sometimes you don't know why it's happening, but if you just looked at the price and volume equation, and then if we modeled an equation on it, we modeled an algorithm on it, and we said if we just bought stocks which showed strong momentum and exited out of them when they lost that momentum, purely quantitative. So we're not taking subjective decisions. With some filters in place to avoid too small stocks, too little volume, and maybe perhaps stocks that move only in circuits. We then get a strategy that can say, does this portfolio work overall? The answer to that seems to be yes. Over a long period of time, we've been running it both as a research portfolio earlier, and then in actuality for the last about 18 months. And what happens really is that when stocks go up, you may have 10 stocks in a portfolio, 20 stocks. A few of them will give you super normal returns, and a few of them will stop out. So they may give you. So when you win substantially more than when you lose. And on average, even if you're right half of the time, you make a fairly substantial return, even when back tested. We actually have been running this for about 1.5 years, and we've seen it happen in real life as well. The advantage of this in this market turmoil is that once in a while, the strategy will tell you there are no stocks with momentum. And that's what happened in March this year. There were actually only 2 stocks out of the 20 that, we have 20 positions. So the market actually told us you can't be more than 20% invested because there is not enough opportunities out there. So we ended up being 80% in cash, and that saved us substantial amount of the downfall. So instead of falling 30, we fell 10. During the recovery, a few sectors started to show up in the momentum algorithms much earlier than perhaps we weren't aware of the fundamentals at the time. So a lot of pharma stocks started to show up in mid-May to early June. And some of those stocks have given us 2x, 3x returns just riding through that momentum. It's a passive portfolio, requires discipline because you can't question it too much. Because if you question it saying, I don't want to get out of the market because it's falling, then you will lose money. This kind of a strategy, you lose money. So you should actually not just use discipline and not question it too much. But that's what's worked for it. It's done about 34% in the last 1 year. But more importantly, it lost less in the downturn. So little less heart problems at the time.
Fantastic. So on that note, let me get Amit in. Amit, even your portfolio has delivered return in excess of benchmark. Tell us how difficult it was for you to protect the alpha during the which was at the beginning of the year during this turmoil period, right? The pandemic time. How did you sail through the pandemic time?
Good evening, everyone. Thank you so much on having me on this show. Well, the first thing is that I would like to thank the Fed. Last year, our returns came because of Nirmala Sitharaman cutting the tax rate. This year, I would say our returns came because of the Fed. So the Fed decided that the only way to get out of a bubble is to create an even larger bubble. So that's what the Feds did. We're up about 28% this year. It's done okay for us. So our portfolio is divided into 4 sectors broadly: consumer, pharma, financials, and technology. Typically, consumer and pharma protect our downside. That's why in the first 3 months, when the Nifty was down 35%, the Nifty 500 was down 35%, we were broadly down half of that. We were down 17 odd percent. That was the first quarter for us. So our alphas came basically by protecting the downside. So that's the defensive part of my portfolio. B2C facing companies, we broadly invest 90% of our portfolio in B2C facing companies. They're in 4 sectors. So financials, and my tech portfolio did take a knock because these are broadly more linked to the economy, whereas my pharma and my consumer was protecting me on the downside. And on the way up, our pharma stocks did well initially till in April, May, June. Then our tech caught up. And last 1 month, as you know, Nifty is up 20. Bank Nifty is up 24% this month. So our financials then caught up. So that's how our portfolio is divided. We are growth investors. We look at companies where we believe we can compound capital at 15-20% plus. A majority of our portfolio holdings, except in consumer, where we are okay with 15% kind of growth, 10-15% kind of growth. In our financials, I will not buy a company which is growing at 15%. If I'm taking on leveraged positions, I want higher growth to compensate for the risk. If I'm looking for 10-15% returns, consumer can give it to me. So that's broadly, that worked well, but I cannot thank the Fed enough for doubling their balance sheet size.
Coming to you, Rakshit, let me get you in. Rakshit, Marcellus CCP is one of the fastest grown PMS in last year and a half or so. And, picking up from what Amit said, I think you were high overweight on financials and chemicals. And still, in spite of that, you've been able to maintain the consistency of the consistent compounder portfolio. So what was the secret recipe behind that your TWRR returns, the portfolio customer entire pool of your return looks consistently stable? What's that? What goes behind that?
Yeah, thanks for articulating it like that. That is exactly how the portfolio has actually performed. If you look at the last 12 months, it's up around 27-28% versus Nifty around 9 or 10%. And even since inception, it's a very similar number of absolute return as well as alpha versus benchmarks. The reason, and this reason also relates to what happened during COVID. First and foremost, our portfolio is exposed to only stocks that sell products and services of day-to-day essential small ticket items to mass, affluent, and upwards customers. So that gives the low volatility to the kind of industry demand that they're exposed to, and hence COVID, no COVID, GST demonetization, or whatever other disruption you bring in, the demand destruction is not massive to begin with. On top of it, these companies that we pick up in particular, they're all they've built very strong barriers to entry around them, which ensures that actually when the environment is tough, when there's a disruption out there in the broader economy or a macro challenge, these companies benefit more than in an environment when there's euphoria all around. And that is because gaining market share becomes easier when your competitors are dealing with challenges which are probably related to the macro, as they've been the case last 3, 4, 5 years. So that's the reason why, whilst in a euphoric environment, these companies do well. Even in a stressful environment, they gun out a very similar earnings compounding, and hence the share price compounding. Plus, on top of it, it's a portfolio concentration. So we've got only 13 stocks in the portfolio. And since we don't dilute the quality of the portfolio by holding a very long list of stocks, it helps that much more to the return outcome.
Sure. So, Jayaram, getting you in, there has been a debate around value as a theme, and value underperforming value has been underperforming for quite some time. Tell us how you could pull up such a stellar performance. in being having a value orientation?
I'm pretty close to Mr. Rakshit Ranjan's principle of
Can you?
stock picking. We concentrate on stocks which have got visibility.
Yeah. You are audible. Yes.
So our concentration of stocks, our concentration on stocks which have underlying.
Rakshit, you are a chemical engineer and you have a overweight on chemicals. Do you think it can turn a recurring winner? It has a potential of turning a recurring winner. And also talk to us about the other sectors which worked for you in last 1 year or so.
Sure. So, I mean, to begin with, let me give a simple generic view on this question. Macro themes very rarely make money for investors via stocks in Indian markets. So it is true that there is a macro tailwind to the chemicals industry, whether it be demand substitution from other countries that India is benefiting from or something else. It is also true that certain other industries are currently facing tailwinds, so on and so forth. But such macro tailwinds can, in our view, not be the way to make money from stocks, because stock selection is very important. For instance, who would have thought that something like an Asian Paints or a Berger Paints, in a COVID time when nobody wants labor workforce to come into their houses, and these companies will deliver double-digit volume and value growth right from June month onwards, right? Whereas who would have thought that in the telecom space or in the airline space over the last 16 years, when the overall industry volume growth has been exponential, even the leading companies will not make any money, right? So in that way, I think it's the stock selection which matters more than just macro tailwinds. What has worked well in our portfolio so far is a third of the portfolio is, well, about 30% is exposed to lenders. So we've got the likes of HDFC Bank, Bajaj Finance, Kotak. And not only is India's credit growth a very healthy one in a normal macro environment, but in the aftermath of a crisis like, say, a COVID, there's a massive opportunity to be had over the next 2, 3, 4 years. So what has worked in the last 2, 3, 4 years will probably get accelerated in the lending space. That's one area where we are exposed, and we've had a good performance. Then when you look at, let's say, discretionary consumer categories, there's a lot of unorganized to organized shift that has happened after GST, after demonetization. And only the stronger companies have benefited from this shift in the most meaningful manner, not so much the weaker companies. And likewise, we have a couple of pharma companies, say an Abbott or a Divi's, which are not the typical sort of pharma models of manufacturing in India and sell in the US. These are totally different pharma models. Abbott is more like an FMCG player. Divi's is a pure monopoly in sort of cough syrups and painkillers, etc., APIs. So in that way, it's the company-specific monopolies that on top of a very resilient macro for their underlying categories that has benefited us through all these years.
Thanks. Amit, how do you evaluate where you should be at a given point of time? Where you should be at what point of time in the market in your investing? You have to unmute your line, Amit. I'm not able to hear.
The way we think is that if we have to change the portfolio again and again, based on what I think on the economy is the wrong portfolio, we will remain in these 4 baskets. These are businesses that will get better with size. These are businesses which have intrinsic 15, 20, 25% kind of compounding capabilities. These are businesses which are leaders. We want growth. So if a company does a 70% ROC and a 10% growth, we can keep it as a defensive part of our portfolio. But in our humble opinion, from these places, you don't make a lot of money. So you want some part of your portfolio to be growing very fast at 25%, and then some part of the portfolio where you're okay with saying that, okay, these are my defensives. They will not help me in good times, but you know what, they're going to help me in the bad times. So our portfolio is very balanced that way. So we try to keep our portfolio betas low. So our portfolio betas are typically around 0.75, 0.8, and we don't like to go more than one portfolio beta. So as long as you can manage, because in Indian market, so my understanding is that every 4 years there's a mid-cap bull market which happens in India. It happened in 2017, it happened in 2014, it happened in 2010, it happened in 2007, it happened in 2004, it happened in 1999, and probably you'll have one very large bull market in the mid-cap space in 2020, 2021 that we are already seeing. Market chases growth in bull markets. So growth, but as long as it is backed by decent quality management, as long as your ROCs are higher than your growth rates, so that you don't have to dilute capital. If you can get a few things right on your with growth rates, typically your competitive advantage in B2C kind of companies keep growing. So that would be our style. We would focus more on growth. We always focus on growth, but in a bull market, you need 3, 4, 5 stocks that you believe will grow at 30-40% plus. Market chases growth. In bull, bear, every market condition. With 0% interest rates, market will chase growth. With 3% interest rates, market will chase growth. Of course, the quality of growth also matters. So you cannot buy companies which have like a 12-13% ROC and growing, or a 10% ROC and growing very fast. You want companies. So we are not value investors in the traditional sense. What we look out for is how much capital the company is generating. So our way of valuing a stock is the amount of money a company can reinvest into, at what ROIC it can reinvest, minus cost of capital into competitive advantage period. So as long as my companies can reinvest 50, 70, 80% of the capital they have at very high rates, I would be at very high ROICs. I'll be very, very happy to own those kind of companies. So tech is the place to be. Tech is the largest overweight in our portfolio. Financials are overweight. Pharma is little less because we don't do B2B pharma so much. So we have less pharma.
Really nice. Coming to you, Jayaram, coupled with the previous question of your performance, where do you see value in today's market environment? Which pockets do you see value?
Yeah. Sorry, I had a bad line earlier. Now coming to value, I see value across segments. When you say across segments, we have got a good concentration on industrials, and we have got a adequate concentration on IT and FMCG and pharma. For us, in the last 2 years, pharma, IT, and industrial engineering has done phenomenally well, generating a very good return on the portfolio, with FMCG also chipping in with a very moderate return as expected. So we do see value across segment. There's nothing like one better than the other. For example, in the last 6 months, our concentration has been on specialty chemicals, which has done spectacularly well in terms of market performance. And we do see enduring value with all the PLI schemes kicking in. We do see enduring value in this segment. So there's no one segment we look at. We look across segments. We typically invest in companies not in the stock market. So really, we don't have any preferred industry for us to invest. If we see value and we see the prices correct, and we see the other academic financial formulas all falling in place, like the earlier speaker referred to, we just make our investment and kickstart adding to our portfolio. That's it.
Deepak, getting you in, do you think that sector rotation is even required in your style of investing, the kind of portfolio you run? What role does sector rotation plays in that? And tell us something about that.
So I think in momentum, which is a quantitative strategy, sector rotation is a consequence, not something we initiate. So I don't say let's go to pharma. the set of stocks that are selected typically converge on a sector when the sector starts doing really well. We invested, for instance, earlier this year. It was surprising to see, for instance, suddenly a bunch of pharma stocks entering our portfolio, because pharma hasn't done anything for the longest time. And suddenly Laurus and Aarti and a number of these companies started appearing in the portfolio. And then because it's an algorithm that kind of selects the stocks based on a predefined criteria, we were heavy on pharma for a while. That transitioned later towards slightly heavier into IT. And today, I think the IT part has been replaced. A little bit of the IT has been replaced by the financials. So the financials have started to come in. It's very fascinating to see this, though it happens slowly because we change the portfolio. Perhaps a little part of the portfolio changes every month automatically because of our rebalancing. So sector rotation is a consequence, and it's fascinating to see this because once you see a sector, then you can analyze it more fundamentally as well to see how it's going. But the data actually tells us signals before we can sometimes figure out from the fundamental perspective as well.
Rakshit, there has been talk about invest in India and markets peaking out, and and India looks very expensive. Do you tell us that how relevant is PE when global liquidity is available at abundance, coupled with lower cost of capital, low levels of inflation, resulting in higher expected real returns. How do and also about in the past in your CCP you have done some of the some exits as well. So how do you decide on these exits, and also about the market levels? Does it even bother in terms of your style of investing? Should I repeat the question, Rakshit?
Yes, sorry, I got the part where you were asking how relevant is PE multiple.
So
but
I said that
the
how
second part,
relevant is PE
there
multiple
was
when there is liquidity available in abundance, and coupled with lower cost of capital, low inflation,
okay.
and which resulting in higher real expected return, right? So how do you and also about talk to us about your exit strategies, in your PMS. How do you decide you want to exit? What are the rationales which you look at in terms of exiting a company?
So very good question and very relevant, especially given where PE multiples are today for many stocks that we hold in our portfolio. So look at it in a very simple way. When you consider an equation where the share price is a product of P by E multiple and its earnings, in a way, this equation is also telling you that the change in the share price is driven by two changes: one change in the PE multiple and change in earnings. Now, that means it's a combination of two factors. If you make one factor very strong, the other factor becomes sort of less important in the equation, right? And hence, when you look at companies where earnings compounding is weak, PE multiple is very relevant. And if you don't get expansion of PE multiple, the share price won't compound in your favor. Whereas if the earnings compounding is very strong, first of all, the PE multiple will not be disastrously volatile. More importantly, even if the entire market deflates PE to half of its previous levels, your portfolio's PE deflating to half will not lead to the share prices going into the negative from a, say, 3 or 4 year perspective as well, right? So in that case, provided the earnings compounding is higher than 20-25%, the PE multiple change becomes sort of a non-event in the nature of the outcome. Obviously, it affects the calculation of this equation in terms of getting the share price compounding run rate. But I think to us, to our investors, whether you get 18-20% or 25-27%, it's more or less the same in terms of the nature of the outcome. So that's answering the PE part. And hence, I think when it comes to the overall portfolio construction, we are more worried about whether earnings will continue to deliver or not, which is also the reason for our exits. Wherever we see wherever we see our confidence level drop in the longevity and the strength of the earnings, we would consider exiting such a stock. It might not necessarily be an exit if we believe that earnings momentum drop is a blip. So, for instance, whether it be a binary event like, say, a Groove Finance, the housing finance company which got sold to Bandhan Bank, that was a binary event which changed our perception of earnings compounding thereafter, or whether it be a gradual change which happened to us in the case of, say, we used to hold Marico at one point of time, and the conviction level sort of gradually reduced a little. Not that the company is doing anything wrong, just that we sort of thought there is a substitute available. So having a concentrated portfolio of high growth earnings is the objective. Wherever a stock doesn't meet that criteria, we sort of decide to exit. P multiple, as long as it's sort of 30, 40, 50 times, it undervalues longevity heavily. And hence we're not so worried about a 30, 40 times P multiple.
Amit, getting you on this, do you think market peaking out, does it even bother you? I mean, you spoke about that, you look at, companies which are growing at a very high rate, it would definitely impact your portfolio, right? When, market is sort of peaking out, or the growth sort of starts slowing down. So, so tell us that, what is the typical holding period you look at in your in portfolio companies, and does the market levels really bother you or your style of investing?
So markets level, I believe there's a 10%, like 50% probability of markets falling 10% or rising 10% for years. So we don't, like let's say from Nifty is at 13,000, I'll say there's a 50% probability of we going to 14,300 or coming down to 11,700. So we don't try to time the market. We've seen people who try to time the market typically end up selling at the worst time. We will stay in the market come what may. If Mayawati becomes prime minister, we will stay in the market. If Corona comes, we'll stay in the market. If Joe Biden becomes prime minister, president, we will stay in the market. So there is no question of exiting the market ever. The second question, are the markets at peak? Who are we to say the markets are at peak or this is just the start? In fact, Deviprasad ji, I was more scared when money used to come in buying at 10,000 Nifty. But we still said that whatever happens, we have to be in the game. See, at 10,000 Nifty, you had bigger problems of wave 2 coming. Every time you open, example in ET now, they would speak about, every guest would speak about how NPAs would come, how banking system, which does a 2% ROA. Think about it, Deviprasad ji. Uday Kotak was selling his shares at 1150. ICICI, and not small stake, 4% stake. There are only 2 times a bank dilutes. When you need growth capital or you provide for, just before a large provision, you sell your stake. Uday Kotak was selling out. He also didn't know that in 6 months his stock price is going to be 1900. He was selling out at 1150 bucks. ICICI did the largest QIP of. If the bankers themselves were panicking, it was scary to buy financials, especially during those times. But you have to have that kind of thing that I'm going to stay in this market, come what may, and that works for us. So if someone tells me that he knew that Kotak will come back to 1900 in 6 months, or Bajaj Finance would come to 4900 today in 6 months, I would believe that that guy is a liar. Because it was very difficult to say that what the stock price would be 6 months from now. All you would say that if these franchises survive and the credit cost is not very large, then these companies will create large wealth. It was a very difficult situation. But coming back to your point about market timing, if Uday Kotak can't time the market, Amit Jeswani and Stallion Asset definitely cannot time the market.
Jayaram, coming to you, should a value investor even consider the broader market levels?
Yeah, see, we only try to price the purchase of stocks. We never try to time the market because timing is a pretty futile exercise. And it's, as the previous panelist rightly put it out, it is, it's a waste of time. It's absolutely going to be critical. The future is going to be critical. The only thing that is certain is what are the controllables we can work on. The controllables we can work on is whether I'm paying the right price for a business which has got a sustainable value, which is going to have earnings and visibility of earnings. If these parameters are met, you do consider the shopping of stocks, and the price is only the criteria. And trying to time the market is absolutely, in my experience, a very futile exercise. And I haven't seen anybody successfully doing that except out of chance once or twice. That's it.
Sure. Deepak, before we wrap up the session, Deepak, coming to you. There has been, during Diwali, there has been a clip which was floating on the WhatsApp group, which was from the recent scam web series, which said that invest in India, India ka bhav badhne wala hai. Do you like to second this? Your line is muted.
Zero.
Yeah.
Yeah. So to be fair, I don't think as Indians we can't invest more than $250,000 per year abroad. So people are more than that. There's not much you can do with the money. But I think we have there's nothing wrong with the Indian growth story. So I mean we're going to have hiccups. There's COVID has created issues. We saw today's GDP number came in at some -7%. This is going to happen once in a while, but you have a country which has a tremendous amount to grow. Every percent GDP increase from now on will take about 2 crore people out of poverty. We today, to give just as a comparison, we sell as many cars per month, a little bit more than France, which is a country 1/10 our size. We are growing economy in many ways than one. And in a growing economy, you will get growth. It's almost like a given if we don't, magnanimously screw up or do something really bad. But I think buying India is a no-brainer. I live here. I have bought into this country by birth, and I'm continuing to buy into this country. So I don't think there's any doubt about that. I am a fan of quantitative metrics to invest in markets, but I'm also cognizant that if there weren't a sound fundamental that drove this, if there weren't theory that said these markets are not manipulated, some stocks maybe, but overall the market is not, and that there was scope for merit in growth, then I wouldn't even be investing in these markets. I really think the long-term story is here. It's us, and we have to make it happen.
That's really good to hear. So that brings us to the end of our session. While every finance book, or any topic discussion has one thing in common, which is profit. It's quite evident that profit is the output of a lot of hard work. That's what you all have talked about. It's not by fluke. It's mix of a strategy, research, decision making. A lot goes into that, and thus carries a risk of going right or wrong, and hence needs to be rewarded for. So it was fantastic interacting with all of you, and great inputs. I'm sure the viewers would immensely benefit from that, and I would like to take this as an opportunity to thank all of you, the panelists, and the PMS Bazaar ET Now team to organize this, and thank you very much for having us.
Thank you very much. Thank you, everybody, our esteemed team of panelists, and of course, our moderator. Thank you so much for all of your valuable insights today. Everybody is looking at how to make money, which I think is sort of been one of the most important questions through the generations. And thank you so much for all of your wonderful suggestions and valuable inputs. Thank you for joining us amidst your busy schedule and being a part of our virtual summit. Thank you very much.
Thank you.